think the drivers are big money waking up. Now, you could argue that the public is not even part of this rally yet. What happens when they collectively wake up? This is being driven by people at the highest of levels before the public catches on, which is another contrarian indicator. So, yeah, I think what's driving gold and silver is that silver is finally catching up. Gold is being rewoven into the monetary fabric of the globe. And thankfully, someone in this administration, I think, grabbed President Trump and said, if we don't do this, we will forever regret it. This is our last opportunity to bring some of this home, because the world is moving away from treasuries and dollars and paper.
What differentiates this rally from past cycles is the broader structural shift underway in global capital flows and strategic resource planning. Key economic powers, including China, Russia, India, and Saudi Arabia, are bypassing conventional market mechanisms to secure direct access to physical metals, often at premiums, reflecting a growing urgency to de-risk from Western financial systems. The recent reclassification of silver as a critical mineral by U.S. authorities further underscores its evolving role in both economic and national security frameworks. Schectman sees this as only the beginning of a far more substantial repricing. He notes that sovereign entities and major institutions are positioning early, long before broad retail participation has materialized. With supply constraints tightening and geopolitical risk rising, both gold and silver present a highly asymmetric risk-reward profile, with significant upside potential and limited downside. Once public interest aligns with institutional demand, the velocity of capital inflows could accelerate dramatically. Now, we present the clips from Andy's interview. Before we continue to discuss this, please subscribe to our channel and activate the bell icon for timely updates. Thank you, and enjoy the video.
Well, I mean, it's physical demand coming into the COMEX, coming out of London, coming out of Switzerland. The demand is off the charts. The lease rate in London, which is typically 0.5%, rarely gets above 1 or 1.5%, even in times of stress, and then it would typically only be for a short period of time. The lease rate is the rate at which it would cost to borrow bars to short or to cover a position, is as high as between 5 and 6.5%. And that's an anomaly, to say the least. It signals great tightness inside of the market at the highest of levels. The amount of silver that's coming into the COMEX is off the charts. From a technical formation, you have a 45-year cup and handle that might be as powerful of a formation as you will ever find in technical analysis, especially one that is mature as silver. 45 years, and the way that it works is the beginning of the cup would have been 1980 at $50, and then it goes down to the bottom, the shape of like a bowl or a cup, to $4 or thereabouts in the early 90s, and starts to come back up to 2011, almost to the top of the cup, doesn't preach it, comes down in consolidation for the handle, and here we are at basically $44, very close to moving back up. Now, the way that works is once you breach that level, the top of the lip of the cup, the $50 level, first of all, there is no resistance at all. But the way technical charting would work is that you take the difference between the top of the cup and the bottom, which is approximately from 50 to 4, about $46, you would add it onto the top, and your next target upside would be $96, 96 to $100. Is that crazy? No, it's not. I mean, triple-digit silver is something one could expect at some point. And then when you realize that the government reclassified silver now as a critical element, a critical mineral, they've put a floor under the price of silver. And so I think, all of the talk over the last 6-7 months, and I said no from the get-go, this is not about tariffs, never was. It was a ruse to bring it all back. This is reshoring. This is understanding that the biggest money in the world understands the significance of things like silver. The biggest traders here in the United States, the institutional traders, when they start to pay attention, when they start to accumulate, we should all pay attention. We've been talking about this on a central bank level for few years now, about the deliveries into COMEX for a few years now, about the accumulation by India, by Russia, by Saudi Arabia, by China. China flying around the world and buying doré when they're the second largest producer in the world, sending it back to China for refining. Why would the second largest producer of silver in the world find it necessary to fly to Latin America to buy concentrate and doré directly from a miner, pay double what the West will, ship it back for refining if it were just this, this rock that hasn't done anything forever? And I don't know, silver right now feels to me like gold did about a year ago when it was right in the $2,100-$2,200 range, and it kept trying to break out and would, consolidate and try to break out, come down, consolidate in a long period of consolidation, and then broke through, and it hasn't looked back. I would say that's about where silver is right now. I look at it as the most undervalued asset in the world, and now evidently the United States finds it significant enough to call it critical. I think there are very few opportunities asymmetrically where you have such low downside and such high upside being asymmetrical. For an asset like this, it's once a generation. So I think the drivers are big money waking up. Now, you could argue that the public is not even part of this rally yet. What happens when they collectively wake up? This is being driven by people at the highest of levels before the public catches on, which is another contrarian indicator. So, yeah, I think what's driving gold and silver is that silver is finally catching up. Gold is being rewoven into the monetary fabric of the globe. And thankfully, someone in this administration, I think, grabbed President Trump and said, if we don't do this, we will forever regret it. This is our last opportunity to bring some of this home, because the world is moving away from treasuries and dollars and paper promises. And then you add on to it sanctions and tariffs. After 4 years of nightmarish domestic and foreign policy, prior to this administration, you could argue a system that is fully based on trust has squandered the majority of it. And then, look, I would vote for President Trump again, but I don't agree with the way he is antagonizing even his allies, like India, as an example, throwing on 50% tariffs, and many of the other countries in the European Union and Canada. Maybe there's something bigger at play, which we've talked about a lot, but I think it's just beginning, quite frankly. Look, you have a comment coming out of Goldman Sachs a couple weeks ago that if the market even thinks that the Fed has lost independence, well, okay, the firing of Lisa Cook, who's going to go in there? It'll be a Trump bobo. You look at Stephen Murin replacing the last Fed official who left, who is the author of the Mar-a-Lago Accord. The Fed has lost independence. And mind you, this is nothing new. You go back through history, you'll see this happening with multiple presidents, but it's like they give you crumbs and the crumbs. Well, we told you that this could happen. And now you have, banks talking as high as $6,600, $4,000 being base case for most of these banks. Look, you put silver at 5,000, like Goldman says, and divide it by 70, which would be, way higher than its average for the past 100 years, and still 10 times higher than it's coming out of the ground at. You're talking $75 silver or thereabouts. So, to me, this is just beginning, Elijah. Honestly, I do believe that, and I think this is the time that most of us have been talking about, as typically following suit way early. But I'd rather be months and even years early than 60 seconds late when the switch flips on.
Andy Schectman warns that silver's position in today's market is unprecedented, pointing out that while gold has surged to record highs, silver remains below its peak from more than 4 decades ago. He stresses that this disconnect is extraordinary, given the scale of institutional buying, historic deliveries into COMEX vaults, and growing demand from affluent investors willing to pay rising premiums on coins like gold and silver eagles. At the same time, retail investors remain largely absent, preferring speculation in equities and leverage, a setup Schectman views as one of the strongest contrarian signals in modern markets. Beyond investor behavior, Schectman highlights structural changes that could redefine precious metals. Silver has been reclassified as a critical mineral by U.S. authorities, effectively elevating its strategic importance, while gold is steadily being restored to the heart of the global monetary system as central banks reduce reliance on U.S. treasuries. These moves, combined with persistent supply shortages and rising premiums, suggest to Schectman that a major repricing is already underway. In his view, this moment represents not just a cyclical rally, but a generational shift in how silver and gold will anchor wealth and stability in an increasingly unstable financial order.
So, yeah, I mean, the big money is waking up to it, no question. And when I say big money, I think there's a duty when you have that kind of money to think. And I'll tell you that, and I mean, I'm serious about this. Where do you put your money at a certain point is very difficult, right? You got interest rates that on the short term, the very short term interest rates, which are coming down. I think you'll see the opposite on the 10-year. Will move the other direction, just like it did before, just like we see in London, where they've lowered rates 7 or 8 times, and yet their 30-year Treasury is pretty darn well near its all-time high. The bond market controls the back end, but I wouldn't buy the back end anyway. I would own some 6-month Treasuries or shorter duration, and those are coming down. Where do you put your money when inflation, the real level of inflation, is far greater than the interest that you're receiving for something as safe and liquid as a treasury? What happens if Trump gets his way and they lower rates 200 basis points to 2%? And the CPI, which is at 3.1% right now, is actually higher than the rate that is stated. Big money won't stand for that. We know that the CPI, because you've had John Williams on this show, will tell you it's 11% right now. Add an 8 to it, the way it used to be measured before they changed it. Point of it is where do you put your money? Stocks at all-time highs, bonds at not quite all-time highs, but losing demand rapidly, so much so you create something called the Genius Act, which it is kind of diabolically genius, to create synthetic demand for U.S. treasuries because the organic demand is waning. Where do you put it? You put it in real estate at all-time highs. You put it in banks that are over-leveraged and undercapitalized, where you are now a unsecured general creditor with bail-in laws. So, yeah, I mean, I think there will come a moment where the public at large realizes this, but the big money is asking these questions every day. What do I do with all this money? And no one would have ever thought that having that kind of wealth would be such a pain in the ass, such a difficult thing to safeguard. And as you get older, you're more concerned about protecting than you are making, because, you're thinking of your children and your grandchildren and how do I pass it on appropriately. Interest rates spike in an environment where there's that black swan. Well, the banks are in trouble, the insurance companies are in trouble, the bond market's in trouble, the stock market's in trouble, real estate's in trouble. Where do you go? And I think people are realizing this. And, it's kind of a softball question for a guy that owns a precious metals company, but if people haven't figured out by now that I try to be as genuine as humanly possible, that I do as I say, they never will believe me. I will just simply say, to me, there are very few places where I think you can safely keep your money with a high degree of liquidity, where the biggest money in the world is showing you through their actions where they're going. And I think you will see that public catch on. But typically, the big money, well, they do this in the cover of darkness, where you got guys like, Jim Cramer, moron, saying, it's too speculative, it's frothy. They're not looking at this the right way, and they're not really part of it. But there are a lot of people who are clued in and understand where we're going and what's happening, that are buying gold and silver as a life raft. And that's the way that I look at it, but not just for an emergency, right? It's for an opportunity as well. And maybe having that dry powder in the form of something that is keeping its purchasing power against a dollar that's down 11% this year and gold up over 40, it's keeping its purchase. You go back as far as you want, and I can make this analogy in real estate and in anything. Gold maintains its purchasing power, and most other items across the board, from food to energy to real estate, measured in gold, it's becoming cheaper and cheaper and cheaper as things measured in dollars are becoming more and more and more and more expensive. You can pick anything you want, automobiles, college tuition, and I have an answer for it. And that's the scary thing. I wrote one thing down to kind of show that it just kind of caught my attention. And it's just very simple. In 1978, a student working full-time summer job at the minimum wage of $2.65 an hour could earn roughly $1,378, which was more than enough to cover the average tuition and fees of $688 at a public university. So when you talk about inflation outpacing standard of living, it's extraordinary. But if you look at gold, at its value, since then, since 1978, when it would have been priced at, I don't know what it was back then, a few $100s anyway. But point of it is that, look at where gold is today from where it was then. In fact, let's just look real quick just to make the point. We'll see where gold was in 1978. What was average gold price in 78? Was $193.4. So if you are earning minimum wage and you're able to make, what did they say, 1,378. So 1,378 divided by 193.4. Well, you would have bought 7 ounces of gold with your minimum wage summer job that today would be worth $26,000. So that would cover your tuition in most public schools. A lot of the highfalutin ones are going to be 3 times that, because college is probably a poor example showing how much it's outpaced itself. But point of it is that, what is $1,100 worth, and that gold and silver have done a wonderful job in the face of a dollar that is destined to continue.
If silver continues to break out from decades of stagnation, the effects could ripple far beyond the commodities market. A sustained move higher would likely force investors, policymakers, and institutions to reassess its role not only as an industrial metal, but also as a strategic financial asset. Rising prices could trigger a surge in global investment demand, particularly once the broader public recognizes that silver is still historically undervalued compared to other commodities. That shift would tighten supply even further, amplifying volatility and driving premiums higher in both wholesale and retail markets. If you found this analysis valuable, don't forget to hit the like button, subscribe to the channel, and share your thoughts in the comments below. Your engagement helps bring these critical discussions to more people who need to hear them.